Okay, perfect. Okay, so welcome everyone to the webinar. I appreciate you guys for being here, and thank you, Luz, for hosting. We have a lot to cover. I want to make sure that Luz has enough time to go over the slides. So, like I mentioned before, I only have like 4 slides, so it should be pretty quick on my part. A little bit about me. Can you click it? All right, a little bit about me. My name is Luis Esparza. I've been doing real estate for about 4 years now. And when it comes to working with me, I like to keep it fun and as stress-free as possible. Now, a little bit about my personal life. I'm married, no kids yet. I like to play golf and try out new coffee shops. And when it comes to buying the house, though, like everyone's here for, there's 8 steps, but we won't be going over this today because it takes about 45 minutes in total. So I definitely want to meet in person and go over this. Like I mentioned in the beginning, I want to make it as stress-free as possible. And the way I do that is by sitting down with you, getting to know what you're looking for, and basically explaining the process from start to finish and include any possible scenarios that could come along the way. That way, you're not surprised by anything that pops up during the transaction. Now, I'll also be going over number 4, where we will sit down together and see what a purchase contract looks like. So that way, you know what a contract looks like, even before you're ready to submit an offer. I think that gets you ahead of the game compared to most. Now, one last thing I want to mention is that I will be doing a upcoming seminar with a home inspector. That way you know what to look out for when it comes to a home inspection. He will go over major red flags such as foundation, roof, electrical, plumbing, HVAC. So if you find that valuable, I'll send you more information once I have a date set. I'm thinking either between June or July, but I'll let everyone know and send out an email. Well, if anyone has any questions for me, I'll pass it along to Luce now.
Awesome. Well, thank you, Luis. I think the home inspections are always really important and something that it's not covered frequently in seminars like this. And it's such a critical part of the whole transaction, right?
Exactly.
Lending itself, it's already a mouthful, and then the real estate part of it, it's even more in depth. You need to have all those steps. You need to know what the process looks like. I always tell my clients that the people that have the best experience in the buying process are the ones that were educated on
Hmm.
everything you need to know about buying, whether it's real estate or the lending aspect of it. And this is why you're here. It's to learn, not just the lending side of it, but a little bit of steps on how to also obtain your home, which I'm sure you're going to
Right.
have as a follow up with them. But thank you so much, Luis, for doing this with us. We're going to get right into the lending part of it.
Should I
Let
stop sharing
me,
my screen? Where do I go
yes.
for that?
hmm
All right.
Yeah, you should be able to. You're fine,
All right.
right?
Stop sharing. Okay. Cool.
Okay. Well, I don't know how to get myself in that little corner from here on.
I think it's to just drag it, but
Okay. So, but you guys can see me, right?
Mhm. Yes.
Okay, awesome. Let me move this over. All right, so a little bit about myself. I've been in the lending industry. This is my 26th year. I've been putting 20 plus just so I don't give up my age. But definitely over 2 decades, and it's been a wonderful career for me and my team. We've been working with first-time buyers since day one. We focus on down payment assistance programs. This is what we really are recognized for. And of course, we do a lot of different financing options, but DPA is our specialty. We work alongside with the state of California. I am CalHFA's preferred loan officer. And what that means, we just closed a lot of loans with them to be able to be in that list. I am also facilitator for Freddie Mac, which we host quarterly workshops for our clients that are in our database who need a little bit, not just financing help, but also financial literacy help, right? So people that are just barely getting their foot into the industry, just wanting to learn more, getting their finances ready to be prepared to buy a home maybe next year. So some people, besides the lending part of it, they want advice on just general financial literacy when it comes to purchasing a home. So we do that as well. So if you or any friends or family are interested in joining, send us an email. This is just a invite only type of event. We don't promote these online. So we can only manage about 3 to 4 families for every course that we do every 3 months. Okay. Um, I am supported by a team, so I'm not alone. So you will get to meet my team in the process. So, don't feel like you're ever going to be left behind. We want to make sure that you get all the education and all the process when it's possible. I am a mommy of 3 big ones. And my newest little one, it's my new puppy. His name is Bo, like David Bowie. And he is wonderful. So that's my new little baby in my household. And I've been married to a wonderful person for over 26 years. So I spend most of my time and balance between financing. I enjoy my garden very much. That's really what I do most of the time. Make sure I get home before the sun drops and water it before my plants die. So very simple life. My goal is to simplify my life and your life as well. And this is why we're doing this financing webinar today. So let's dive into it. Our market, what we're going to talk about, it's a little bit about market update. And I wanted to share this with everyone because it's important to know where the industry is going when it comes to real estate and financing. Does buying make sense? We'll talk a little bit about that, about credit building, types of loans available to you, how to qualify for these loans based on your income and funds that you have available, some first-time home buyer programs, the loan process. We'll cover that. It's really important. I think that people know how the process works. We're not going to go into depth into closing costs or estimates because that's a whole 30-minute webinar, but just briefly tap into what the loan process should look like and what you should expect within your 30-day closing period. And then, of course, our goal is for you to book an appointment right after that. All right. So types of down payment assistance program briefly, where there's grants, loans, forgivable loans, deferred loans, and gifts. Okay. So these are all different types of loans, and depending on the program that you are going to be in, this is what you'll typically fit into. Some of the benefits of down payment assistance programs, it's to reduce upfront costs, right? So when you want to use down payment assistance programs, especially in today's economy, it's going to be to reduce the cost for you to purchase a home. Even if you have your own money, I always tell people, if you can get grants, if you can get DPA programs from cities, from counties, from statewide, why not use it and keep your money saved, especially in today's affordability, everything that's expensive. So if you can save a little bit, why not, right? It makes home ownership achievable quicker than someone that's saving, their additional extra 3% for closing costs or extra 5%, right? It's also going to help you free up money, right? That way you don't have other expenses. If you want to buy new furniture, you want to buy new fridge, remodel a kitchen, this is when you want to use these programs. And it also promotes financial stability and equity building. So if you get a 3% down payment and you have your own money, guess what? You're building equity a lot faster versus not having that much money down. Housing market. This is really interesting and I love sharing this. This is a today off the press, in March, April, what does it look like when it comes to the housing industry? The number one question I get asked when, obviously, I'm not a realtor, and please, Luis, piggyback on that. I don't do real estate, but I see where the market goes and what the market's doing. In our world in financing, our job is to, determine what kind of loan program our clients fit into, but we also need to know exactly where the housing market is going. So the number one question we get asked frequently is, are prices going to drop? Okay. We go based on data, right? I love looking at analytics. I love looking at data. I don't pay attention to the noise, to social media, to Instagram, to the news. I looked on facts, and this data comes direct from Freddie Mac, which is one of the government agencies that talks about where the housing market's going and what are the trends look like in the last year. This is LA County. And again, you can go to Freddie Mac's website under market trends. You will see this information. So the market trends look like it's kind of flat. Look at it, what it's done the last year, right? Properties, depending on the area, are in the market anywhere from 35 days to 60 days, right?
Right.
depending on the neighborhood. If it's a hot desired neighborhood, the property is going to go in 2 weeks, right? If it's a cul-de-sac, beautiful ranch home, it won't last in the market for one day. If it's priced well, it will go away. But this is just an average what it looks like. We've been kind of on the flat line on property prices. We just came from a event in Arizona where we had an economics forecast talk to us about what does it look like for the rest of the year. It's going to look like this, right? It's going to look right straight. Properties are, some are going to be a little bit higher, some a little bit lower, but this is what we're looking at the rest of the year, which means it can be a very great opportunity for you to get into a home because you're not looking at prices to get higher on a very rapid pace. Also, interest rates are going to be holding up, and I'll share with you what that looks like. Um, these interest rates were from last year to year to date. So it might not seem that rates are dropping, depending on where the market's at. But from last year to this year, it has dropped significantly. Okay, last year we were about 6.875, just some days were around that range. But overall, if you're in the right window, you can get a rate about 6% to 6.375, which is 0.5% lower than we were 1 year ago. Okay, so rates are dropping, believe it or not. We are stable, so that means lower rates, good housing market, good opportunity. This is where you want to be able to become a homeowner. Okay, because some of these properties are in the market for a little bit longer. We may get some closing costs from the seller. 8 of the 10 transactions we've done in the last 2 weeks have seller credits. Okay, they all have, 8 of them have seller credits. So whether it's location, property negotiation skills, you need a great agent to go over these steps. They have credit, and that means this is the market we want for a buyer. This is where the buyers can also win. The seller can win too, but it's really primarily for a buyer. So trends are really important. We're following this very carefully. Rates are stable anywhere from like 6% to 6.5%, depending on the program you're using. Best website to look what rates are doing are CalHalfa's website. That's a government agency that posts the rates up daily. That's your indicator of what rates are doing for a first-time buyer. So today we were 5.875. So that was a phenomenal interest rate. So if you've been planning to buy, this is when you want to start making those choices because you will have an opportunity right now to do so. Right, Luis? What's your feedback? What's your recommendation? You're the pro on this.
Definitely, and I definitely agree with you. So everything's basically localized. So depending on
Yep.
what city you're looking at, you're gonna have some advantages or maybe not advantages. So, for
Yep.
example, I'm helping a buyer right now in Cerritos. There's only 23 houses on the market right now for
Hmm.
Cerritos. To make it even more challenging, they're only looking for a first level floor, so
Yep.
a first story. So Cerritos has a lot of two stories, so their window or their openings is a lot smaller, but being
Yep.
Cerritos, it goes a lot faster when it comes to houses in the market.
Yep.
But compared to, like, let's say Long Beach, yeah, you're seeing 34 days on market for single family houses, and for
Yep.
condos even longer. You're looking at
Yep.
50 days on market.
Yep.
But like you mentioned before, it's a really good time for buyers to be able to negotiate and ask for the seller's credit.
Yep.
That's definitely a good time.
Yeah, absolutely. So this is our live rate today. This is based on the US weekly mortgage rate averages. And again, this is nationwide. So depending on the state, the rates are better. And they're all indicators that it's declining, right? We are about 0.5% better and 0.5% better. And in Southern California, it's about anywhere from $300 to $500 of improvement in your mortgage payment. So good news for first-time buyers. So we love this. We want to keep seeing this. So hopefully, I would be really happy if we're right at 5.8 to 6% all year. I think that's really the ideal part, but I will take 6.30 any day. All right. So interest rates, right? Now that we talked a little bit about interest rate, what is the best interest rate? It's really going to depend on different factors. Loan program, down payment amount, loan terms, whether it's a fixed or an adjustable, your credit score is going to matter where it's going to be placed on the kind of program. So credit does matter. And I'll share a little bit what's happening with credit in a little bit. Buying down rates also an option. So sometimes your neighbor says, well, I got a better rate than 6.3. And you're wondering why is Luz not quoting me a 5.7? What they didn't tell you, it's probably that they brought down their interest rate. So they paid an additional fee, or the seller helped them pay that fee down to lower the interest rate. So this is some of the factors that are moving interest rates when you're purchasing a home. So your story, it's not the same as your friend's story. Okay. So what one bank is quoting you, it's going to be very different than what we're quoting you because the programs are going to change. So you have to be very educated on that, making sure that you understand why you have that interest rate, why you're being quoted that rate, why is it costing you that much, and all that stuff just needs to be explained. As a first-time buyer, you always need to have that feel-good experience, that when you close escrow, you feel good about it because it's a big purchase, right? You don't want to go in to buy a house and then afterwards have doubts that you overpaid. It's like a plane ticket, right? You're looking at kayak.com. Am I going to get a lower price tomorrow? Right? Did I make a mistake? What can I do this right? This is a little bit how interest rates work. And believe me, I'm constantly one that's like, am I going to get it better? Am I going to get it better? So factor in, you want to have that really good feeling when you purchase a home. We want the right mortgage for you. And this is why we do these webinars, is to educate people. Remember what I said in the beginning, that the people that are happy with their mortgages are the ones that got the education behind it. And you're going to feel good about making that first step. Okay. Some examples with interest rates is that if you are paying fees, make sure it makes sense. Don't let, other lenders tell you, pay, you know, 2 points to get a 6% rate. It can take you 7 years to pay up $14,000 in fees. Do you really want to do that? No, right? So we need to have a conscious decision on how we're paying rates, why we're paying rates. If rates on the declining mode, you don't want to pay upfront fees. You might want to refinance in the future. So save your money for the refi. So look overall, what's your expense when you buy this home? So that doesn't mean buying points is the smartest thing. Okay. So we're definitely going to give you advice whether it makes sense or not. All right. Advantages of buying versus renting. Does it make sense? Absolutely. Absolutely. Now, unless you know you're going to move out of California, you definitely don't want to buy and move in a year from now, then no, don't buy. But if you're going to be here for the next 5 years, you need to buy, because what happens if you decide to stay here, you at least bought with current prices, and then you're not going to be jeopardized with an appreciation in the future. So some of the great things about buying is that you're going to have a fixed mortgage, a fixed interest rate. Housing continues to go up every year, but you're going to be on a fixed rate. So your monthly payment's going to be fixed for 30 years. So it's not going to matter if prices of gases go up, food, everything else can go up. But guess what? The biggest expense, which is your living cost, will continue to stay fixed. In 10 years from now, you're going to say, wow, I'm paying nothing for rent, what other people are paying. Everyone that bought a home 5 years ago, 7, 10, 20 years ago are holding on to their property unless they have to move because their mortgage payment's really low, right? And the people during COVID have an amazing 3% rate that they probably are like, do I really want to give up my rate? So buying, it's your best investment. So you want to go ahead and do that. You're also going to build equity, right? So the longer you have the property, the more equity you have. That is your money, right? This is your money that you're going to have for a lifetime. You're going to be able to control home improvements, unlike renting. Your landlord's telling you can't have a dog, or maybe you can't have a large dog, you can't fix the kitchen, you can't paint the house. This is your home. You can do as you wish, and you're going to have that pride of ownership, which is really important. I have not had any of my clients come back to me and say, Luz, buying a house was the worst decision I've made, unless they bumped into a wrong realtor or wrong person or wrong seller, okay, which is really rare. Not, at least in our experience with my team, everyone has been amazing, and everyone is so happy with their first home because they had that feel good mortgage and that feel good sale. So that's really important, okay? Renting, you can't reduce any costs. If you're in a high tax bracket, guess what? You're paying a lot of money to the IRS. You're not earning any equity. You cannot make any improvements. So I think from all of these pros and cons, the biggest one for me and my clients is their cost of housing. That the fact that it's fixed for life, if they want to for 30 years, is probably the most important one, right? All the interest ones, great. But I think if I can get you into a mortgage and that you're going to be comfortable paying, every year you're going to make more money, right? But that mortgage payment's always going to be the same. I
Hey,
think
there's just
that's
a
real.
quick question.
Yes.
Do you have a presentation on, or just you talking?
No, I have the presentation.
I
You
only see
can't see
you.
it?
I don't see the presentation, just
Oh my
FYI.
goodness. Can you see it now?
No, not yet.
How about now?
No.
Maybe you need to stop sharing yours.
May, I thought I stopped the let's see.
Well, I am glad if someone said something.
I just want me to make sure. Yeah, I don't have anything on my end.
Let me see. How about now? Can you see that? No?
No.
Okay, so let me exit here. And then let me share again.
Okay.
How about now? No?
Oh, there you go. I see it.
Yes?
Yes.
Okay. Well,
Yeah.
thank you for that.
Oh, you're welcome.
Okay, well, I'm glad we didn't. So no one was seeing the screen. Okay, so I'm gonna go back just really quick to share the screen. We're not going to, oh, oh my goodness. Okay, hold on. All right. So I'm just going to share the screen with you really quick. Housing market, this is what it looks like. We're flatlining all the way across. You can get all this information from a website. And if you need the links, I'd be more than happy to share with everyone. Okay. And these are the interest rates, how they're fluctuating. So I want to just kind of share the graphs with everyone really quick to see where we're at and how it's functioning. You can go back 1 year, 3 years, 5 year trends. We're focusing on today's trends, which looks like interest rates are dropping. Okay. So I just wanted to go back to this so you guys can see the visual. I'm glad you guys, said something. I could have
Oh, you're
continued.
welcome. I just want to make sure.
All
You're
right,
all good
awesome.
now?
Okay. So this is the pinpoints on interest rates. All right, so let's hop in onto how to qualify for a home loan. So we just covered that, yes, it's a great time to buy in Southern California. Things are not going anywhere, especially with the Olympics coming up. We have a lot of people coming into Southern California. But now let's step into how to qualify for a home loan, right? And I think the number one thing I always tell my clients, it's credit score. It's a big part of the type of program that you are going to receive. So credit score does matter, okay? In the world of financing, we're going to determine the type of loan program you're going to receive depending on your credit score. Most of our first-time home buyers could qualify for a home loan with a 580. Okay, so you only need a 580 credit score to enter into the FHA world. Some we can take with 540, 550, conventional 620, V8 580, and then most of the CalHFA programs anywhere between 640 to 680. Okay, credit score are factoring in judgments, active credit, right? There's regulatory credit, foreclosure, short sale, bankruptcy, all this stuff is factored into the credit. One of the things that we are noticing lately is with the new guidelines with conventional Fannie Mae says credit score does not matter. And what that means is that credit score does not matter with their decision on getting you a home loan because you can have a 680 points and we can meet that minimum of 620. But if you have those 680 points and historically you've had charge-offs and you have credits and you've had a lot of other liabilities that is just maybe not part of your credit score number, but it's part of your history of credit, I am seeing loans are not getting approved by the agencies because of the credit history and not necessarily because of the FICO scores. So we're going to start seeing that in the future where it's going to become a trend where a lot of banks are going to be denying the clients and the clients are going to be like, wait, I have a 680. What do you mean? I only needed a 620 to qualify for a conventional loan. we're going to come back and say, yes, that it's the credit score minimum for the program. However, the underwriting system, it's not approving you because of your history. So that is a new government guideline that just rolled out that says Fannie Mae no longer requires credit score. That's what it means. Okay. The credit score is required by the banks to offer you the interest rate. So that FICO score is going to determine the interest rate you receive, not necessarily the fact that you can get a home loan. So credit's going to matter more than anywhere. Now, if you're not approved with the conventional loan, that's where we have our beautiful FHA loan, who is more acceptable to credit, old credit history. It's going to probably approve you for that versus a conventional loan. I wanted to throw that out there because I don't want you to think 620 is going to get you, or 680 an automatic conventional loan. It still needs to get through an automated approval through us. Okay. The credit score factors are important for every consumer, and we go through that every time we have an application. How long does negative credit impact the decision for an underwriter? Here are some of the guidelines depending on the program. It can be anywhere from 4 to 3 years for FHA and 2 years for VA. So depending on the program that we're choosing for you, there are going to be certain guidelines that are going to impact the credit decision of an underwriter to be able to provide you a loan. This is a lot of information. Don't worry, you don't have to learn all of this. We're going to take care of that for you. This is just some highlights in case, this is a scenario that it's regarding your own credit. Credit usage is important. So as you prepare to become a homeowner, we're always going to educate you to make sure that payment history is really important, and what you owe on your credit cards, to try to minimize them as much as possible so the credit score goes up and the chances of the approval also increases, right? So 30% of your credit score, it's due to credit balances, okay? So if you have one credit card that you owe $500 on it and your credit limit's $500, guess what? 30% of that, it's going to be based on your FICO score. So start looking at the smaller ones. Make sure you're under 30% of those balances and start reducing those monthly payments. Payment history, 35% of it. So try to have everything on auto pay with the credit card as a backup if necessary, to make sure you're never late more than 30 days on any of your payments, because one late can drop about 40 to 50 points on your credit. So credit history, one amount owed, and payment history are the two big ones. Length of credit only makes up 15% of your credit score. So you could have had a credit card for 10 years and not used it, doesn't mean you have great credit. Okay. And we see that often. In use and new credit, it's 20% of your FICO score decision. So having a lot of new credit cards, opening a lot of credit, doesn't necessarily mean you're going to have great credit. Okay. You can have 2 credit cards, and as long as you owe less than 70% on that, 30% on them, you're going to have great credit. So this is a little bit about how the decisions are made. Another thing too, you want to make sure that when you're looking at your credit online, it's very different than when we're running a mortgage credit. Our mortgage credit is we're using FICO scores, which is mortgage rating numbers, versus consumer credit. So you'll see a big difference between your FICO scores. So you want to know where your credit is, just submit an application and we'll provide you that information. Okay, types of documentation, 2 years of employment, 2 months worth of pay stubs. We want to see kind of what your pay activity looks like, so we have no doubt that you're 40-hour working for 40 hours. If there's discrepancy on the hours worked because you were on vacation or sick pay, or maybe your employer worked you less at hours, we're going to ask for that information to document, to be able to support the best income possible. A 2-year job history doesn't mean you need to be on that same job for 2 years. It means that you just need to establish a 2-year job history. So you could have had 5 jobs the last 2 years, and that's okay. Job gaps are also okay, as long as you've been on the current job for more than 6 months. So if last year you only worked half a year, but then since October you've been on the job, then we will take your current pay. So their gaps are, as long as we can explain them, they're okay with the bank. If you're self-employed, we're going to need your tax returns. We're gonna need 2 years of that, and if you have a corporation, we're gonna need your corporate taxes as well. Only if you own more than 25% of the business. If you own less than 25% of the business, we don't need your taxes. Money to buy a home. This is really important for everyone that's buying. It's important to have your money squared away in your bank accounts. The banks doesn't, it's not that we don't accept transfers from one account to the other, but we're gonna make your life a little crazy if you're moving money around. We're gonna want all your bank statements. We're gonna want explanations where the money came from, why it came from there, why don't you use one account? So to have that great experience with us, I highly you encourage that to have one account where all the money that you're saving for it's going to be there towards the purchase of the house. Now, if that's not possible, that is okay. Just be prepared for us to ask you for to document every single transfer, deposit, large deposits that go into that bank account in order for us to use it towards the purchase. And that's where it doesn't get fun doing home loans, right? Because I don't want to ask you for more documents than I need it, but sometimes it's needed to be able to support any conditions from the underwriter. Acceptable funds can come from your personal bank account, checking, savings, 401ks, mutual funds, stocks. Stocks don't before they needed to be liquidated for reserves. Now they don't have to be, so that's something new. Gift funds, depending on the program. If it's an FHA loan, we need to document where the money's coming from if it's gifted to you. If it's a conventional loan, then it just needs to go direct into an escrow company and we don't need to document or bother your donor for any bank statements. Okay, so we'll cover that with you when depending on the program we choose. We want to keep it simple for you. You know, we're always going to need to document everything. You're going to need to provide to us 2 months worth of bank statements, all pages, and a transaction history if there are any current deposits you want to use. All right. Types of loans. We kind of covered a little bit about the difference between conventional and FHA. It's all going to be based on your credit score. But loans are going to have a big role on what you're purchasing, right? Government loans are more flexible with credit. You can have a higher debt to income ratio with these loans. The pros and cons with these programs are going to be, you know, the mortgage insurance premium, and some of them are higher versus other programs. So we're always going to compare loan programs with you. My job is to evaluate your credit history and your job and determine the best loan program for you. And I'm always going to give you a couple of options and let you choose, right? Because even if conventional loan might be a better program, sometimes clients want FHA loans, right? Because they're it's like, no, it's government, it's FHA. By the way, all of the loans, conventional or FHA, are all government sponsored loans. Okay. They just have different overlays. Some people want FHA because they want a streamline behind it, or they have higher debt to income ratio. So then FHA might be the better option, not because it's the better loan, but it's the one you qualify for a house of your dream. So they're going to vary, and we'll cover those things with you. First-time home buyers have a huge benefit to buy a home with down payment assistance programs. So that's I'm always going to ask the question, right? Are you a first-time buyer? Have you hold ownership or title with anybody else on a home? You know, have you lived in that home for 3 years? So we'll make sure we have all the right information to guide you properly. But if you're a first-time buyer, you've never owned a home, you want to take advantage of any program out there for you that's available. Okay. And at least learn about it. Might not be the best one for you, but make a good decision. Don't let someone tell you this is what you're qualified for and that's it. Because you're not just qualified for one program, you're probably qualified for various programs. It's just depending on your credit, you might just only have one choice, but you want to ask those questions. Loans are also going to vary depending you want a fixed rate or an adjustable rate. As a first-time buyer, I don't encourage adjustable rates unless you know for sure you're only going to be in that house for 5 years and then you're going to sell it. You put yourself at risk. Also, adjustable rates are not favorable in today's market. They're very similar to fixed rates, so fixed rates is really the way to go. What's included in your mortgage payment? It's important to ask these questions. Is one of the things we are always getting questioned on. What does my payment have? Am I paying a mortgage insurance on the loan? And if so, why? And why is the mortgage insurance different on my loan than my cousin's loan? And they're all going to be different, right? So when you're making a mortgage payment, depending on the type of loan, some loans will require you to include everything in them. Some loans will require that it will give you the option to pay your taxes and insurance separate. So in California, the law says that you need to contribute 10% of your own money to have the option to pay your taxes and your insurance separate. For down payment assistance programs, even if you give us 10%, you don't have an option. Down payment assistance programs want you to include your taxes and insurance on all loans. Okay. So this is an example of someone that gives us 20% down payment. They're going to pay principal and interest, property taxes, insurance. They're not going to pay a PMI if they do a conventional loan. If you are doing an FHA loan, it doesn't matter how much you give us, you're always going to pay a PMI. Okay. So some of these loans, you can remove PMI as long as you're building 20% of equity and refinance in the next 5 years. Or if you drop your loan balance 20% or below, you can get rid of the PMI. Okay, so all loans with less than 20% down payment will have a PMI included in your mortgage payments. What is a PMI? You know, PMI, it's a private mortgage insurance that's required on all conventional loans and also on FHA loans. All of them are required them, but conventional loans, in order to remove it, you need 20% of your down payment, and that will waive your PMI. Also, too, depending on your credit score and your debt to income ratio, your PMI factor could be lower than your neighbors who had probably a higher DTI and a lower FICO. So this is when preparing and credit matters, because if you're going for a conventional loan, guess what? The credit score number will play a role on what your PMI factor is going to be. Okay, and that sometimes can save you $50, $60 in your monthly payment. And you know, after 5 years, it really adds up on your savings on your mortgage. So those factors are really important to consider. Condominiums too have a higher factor than single family residents. So sometimes it's, you know, worth stretching a little bit more and buying a house versus a condo, especially with the homeowners association fee. So we'll look into all those and compare them from one to the other. So credit scores are going to be a big plus when it comes to a PMI and also your debt to income ratio. Okay. FHA loans will, all of them will have a PMI. Okay. And this insurance protects us, the bank, has nothing to do, it's not protecting the house, the roof, nothing that's a fire insurance. This is a private mortgage insurance. This protects the bank of the risk of you losing your house. We get 80% of that loan back if you foreclose. So this is why we're evaluating the risk as you as a buyer, whether you're going to be paying a high PMI or not. So this is when down payment assistance programs come in a big role, because the more you give us for down payment, the lower your PMI is. The lower your PMI, the lower your mortgage payment, the better you qualify, the better the terms, right? So this is why down payment assistance are wonderful. Okay. I had a conversation with a client today. He had all his money, great credit, everything. He came through CalHFA's website because we get recommended by CalHFA. And he contacted us because he figured that his lender did not offer him down payment assistance program, because they saw his portfolio with a lot of money and they said, well, you have all the money to buy this home. You don't need down payment assistance. Well, you know, needless to say, he called us and he wanted down payment assistance because he doesn't want to use all his money. He wants to have some reserves, right? Especially with the cost of living, you want to have a little cushion before you enter your home. There's programs that are going to help you either eliminate the PMI. There's programs that are going to help you with the closing cost. There's programs that are going to help you with the larger down payment versus a 3%. Depending on your career, what you do, there's programs like the Platinum. Platinum grant programs will provide anywhere from 3 to 5% of down payment assistance, and 2% of that could be a grant and 3% could be a loan. Okay. The grants are not repayable, so that's free money for you. You can use it towards your down payment or your closing costs when we'll determine what best program is for you. The CalHAFA programs, those are the state of California. Again, all of these are state of California funded programs. They're just different nonprofit organizations. If you want to just solely learn about CalHAFA programs, on my website, we're hosting our upcoming event next week with the state of representative from Sacramento. She will be our headline speaker, and she will only focus 35, 40 minutes on all the CalHAFA programs. So you feel free to join that event. But CalHAFA has similar programs where they can assist you with down payment assistance, either for an FHA or conventional loan. It's 0% accrued interest. There is a 1% simple interest. So what that means, if you borrow, $24,000, it's deferred for the life of the loan, and you only pay back $240 of that as 1% simple interest per year on the loan. And again, we can cover all of that in our next one. Today, we're just going to focus on some of the highlights. All these programs are for first-time buyers only. Okay. So if you're a first-time buyer, you can participate in the program. My Platinum program, you don't have to be a first-time buyer, and we actually allow non-owner occupants, co-borrowers on this one. So if you're short of income to qualify and you need a co-borrower and you still want DPA programs, we're going to be looking at our Platinum grant. All right. So here are a little bit of some of the requirements for CalHAFA. 640 credit score for FHA. Conventional, you required 680. Max to debt to income ratio will be 50% with a 700 credit score. If your credit score is below 700, the maximum debt to income ratio is only 45%. So that means you'll qualify for less. Income limits are favorable, unlike other programs, like LA County city programs like LIPA or MIPA have a very low income limitation. So that really limits you on what you can buy in LA, which is probably under 400,000, which I don't know where we can find anything under 400,000 anymore, unless it's a little condo, right? Most of the programs, our Platinum program, we can do a duplex. CalHAFA, it's only single family condos, townhomes, and manufactured homes as well. The programs can also be for use for an ADU. So if you're thinking about buying a house with an ADU to help you offset the mortgage, it is acceptable for this program. Here's some of the county, some limits for CalHAFA, depending where you live. In Orange County, $270,000. That's really favorable. So that means you can make up to 270. It doesn't mean you need to make $270,000. That just means you can make up to 270 to be able to participate on this program. LA County, 211,000. So the income limits are very favorable. So if you go online and you Google other programs, you're going to see most of them are, you can't make more than $120,000 to participate, right? And then in Southern California, that doesn't get you much. So this is why CalHAFA programs are probably one of the highest online Google search for mortgages in the state of California because of the income limits. This is where people are like, oh, well, I fit in here. And they're hard to fit into other programs. But this one will assist you with the 3%. It might not sound like 3% is a lot of money, but if you have your own 3 and another 3% come in from the state of California, you're going to be looking at more favorable terms. You're going to have lower PMI. You don't have to spend all your money for your closing costs. You can use this money to pay for that. So at the end of the day, this is why we're funding a lot of these programs, because it really makes sense for a lot of people to get into the first home. Plus, there's no prepayment penalty, and it's 1% simple interest. I don't see money getting this cheaper besides state of California programs. So if you have additional questions on this, feel free to email us. We'd be more than happy to run different scenarios. I can run up to 4 different options with CalHAFA because they do have loans for down payment and closing costs. And again, we'll cover more in depth how those programs work in our next event. All right, any questions on any programs? I know we went through a lot of information. The goal was just to get brief enough data for you to be able to determine, am I ready to buy? Right? Do I want to submit an application now or do I need to wait a year longer? My recommendation, even if you want to buy a year from now, submitting an application is going to create a roadmap for you. That's really what's important. We have conversations with people every day, and what we do, we don't expect them to buy now. Of course, if we would like for you to buy, but we know that's not impossible. That's not possible for every single household. So we really want to create that roadmap for you. We want to give you advice. This is where you're at now. This is where you can be 6 months from now, a year from now, the cost of waiting a year from now. You want to have all this with you so that way you can prepare. Without having that knowledge, then it's hard for you to be prepared to become a homeowner. And you never know. If you are renting somewhere and your neighbor puts that house for sale and that's the neighborhood you love and you want to be ready, you at least are ahead of the game, right? You don't want to lose that opportunity because properties come in the market every day and they do not wait for you, right? The homes, they sell, they sell. So you want to be prepared for that. All right, let me see. Do we have any questions on any of? Okay.
Doesn't seem like we do.
I don't think we have any questions yet. If you guys have any questions, this is when you want to ask. Um, feel free to ask any questions as we wrap up the webinar. So just a little bit about the loan process. The loan process from the time that you're pre-approved or going to escrow to you close, it's about anywhere from 21 days to 35 days, depending on the contract, right? I sometimes we are starting to see 45-day escrows, to be honest, and that's because we have a lot of people selling and relocating out of state, so they want time to exit their home. So we're starting to see a little bit longer periods on escrows, but the process takes about 30 days. When we start the process, if you don't hear from us, it doesn't mean there's anything wrong. We're just going through the process.
Yeah.
And
Especially like the first 14 days, it's like back and forth, and then there's like a quiet period when there's no news to come up. So people
yes,
are wondering what's happening.
yes, yes. So one of the cool things that we do, we have a lot of automated systems. So every Friday, our clients get an update, no matter what they do. They say your file is approved, your file is in CD. But sometimes from one Friday to the other, nothing really happens because it does take time. Behind the scene, we're doing a lot of stuff, right? So the step starts with the pre-approval. We're gonna run your credit. We're only gonna run a soft pull, not a hard inquiry. We're gonna verify your income, your assets. We're going to go over the buying process with you and different financing options. Okay. You're going to take that pre approval letter and you're going to start looking for a home with your realtor, right? Now, one of the cool things about having a pre approval letter is that you're going to have an estimate with you. So as you shop for a home, you know what the mortgage payment looks like. If you're an active buyer, please always check with us before you start looking for a home, because we want to make sure if you fall in love with that home and you submit an offer that weekend, that you have the right mortgage payment with you. you know
Yeah.
on Monday you come back, we're like, well, no, that's going to be a higher rate. So we don't want you to run into those situations. So it's important that you always check in with us as you're actively looking for homes to make sure those estimates are not changing. Okay.
Yeah, especially when it's a weekend and it's a holiday weekend, and someone wants to submit an offer, but they haven't got their pre-approval yet, and then Monday the seller's selecting the offer already, and yet you still haven't got your pre-approval. So
Yes.
it's definitely tough when you wait.
Yeah, it's really important. And, also too, our systems have a mortgage calculator. So once you apply with us, you have a mortgage calculator on your phone, online, that you can go in there and check your monthly payment. You can just move the needle to see on the price and your down payment, because you're going to know what type of loan, right? You're going to know your down payment. You're going to know what rate you were quoted, and you're going to know the average rate because you were here on this webinar. So you are the perfect buyer. You are the educated buyer. You know all this stuff. You're not going to go out there blindly looking at homes. So once that process starts, we start working internally to send initial disclosures. We're going to start appraising the property. We're going to start verifying your jobs. The underwriter is going to review everything that we reviewed with a with a telescope. They're going to be like, what is going on here? And things that sometimes I'm so shocked because I'm pretty detailed and thorough with all my loans.
Mm.
But the underwriters, it's like they're looking with the magnifying glass to see if they find anything additional to ask for.
Yeah.
So if we ask for additional items, it doesn't mean there's anything wrong with your file. All it means is the underwriting conditions need to be met to be able to get insured by government agencies, right? And believe me, they're going to they're going to see with that magnifying glass, oh, there's a deposit. Oh, what's that little sick pay? What's the little overtime? Explain to me this. So my processor does a really good job for us. So she will ask you a lot of that stuff before it gets to underwriting, and then underwriting will have everything they need. So it's part of the process. It can be sometimes a little bit hideous, but if we collect everything from the beginning, you're going to have a smooth transaction, right? Appraisals and inspections are going to be done early in the game too to make sure that the property is worth what you're paying for. So the bank will appraise it to make sure that we're financing a collateral that's worth the price that they sold it to you for, right? Repairs and inspections, that's something that Luis takes care of. Like he said, he's going to have a webinar just on inspection, so you'll learn a lot more on that. But we're going to be working behind the scenes to make sure all the stuff gets done. We're going to get a hold of the insurance agent to set up your insurance policy. And then after we go through all that, anywhere from the beginning to the processing part, it takes about 14 to 17 days for this to be done.
Mm-hmm.
And why you don't hear from us and we're actively working behind the scene and collecting all this stuff, because there's going to be contingency periods that we have to meet to be able to sign off a loan approval. So we need to make sure we work fast. So we're all a team. You're part of my team as a buyer, right? So if you provide things for me, I get things done faster, we close your file smoothly. Okay. So it's one big team working for you.
Exactly. And I feel like once we submit an offer, we have the contingency periods where it says 10 days for appraisal, 10 days for inspection, uh, let's say 16 days for a loan. Like
Yeah.
I talked to Luz to make sure that she could make it in time so we could, close on time.
Yeah.
Because sometimes we want to submit maybe a 14-day loan contingency just to get the offer accepted. So
Yeah.
I don't want to do that without Luz approval.
Yeah.
So definitely,
Absolutely. Yeah.
communication.
Yes, and you're always checking with me, right? My
Mhm.
agents are checking with me, like, Luz, do you have everything for the buyer to submit an offer for 14 days? And I will be very transparent, say, no, I don't. But I can get it ready for you, right? So I'll call the client, making sure, get me everything because we need to shorten our terms. So this is why, we are a team, right? We need to work together, make sure we get these contracts in and that we have an opportunity to win for you. So this is just a little bit, and again, as we go through the process, we're going to continue to walk you through every single step. Once we open escrow, we always send our clients a home buyer handbook. We explain to you line by line for the closing costs why you're paying those fees. We do workshops just on how to learn how to read your estimates. So if you want to join and hop in one of those, we'll be putting a calendar up in May. And it's just 20 minutes conversations about what to look for in estimates and where to ask the questions if you're being quoted and why those fees are there, because it adds up. You receive an estimate, you're like, what's this $30,000 for? Like, you see like all these fees there, escrow, title, inspections, then it's so overwhelming. And so it's overwhelming for us in the industry. I can't even imagine for the buyer. So that's our job, is to educate you. So make sure you check with us when it comes to that. And we're always on some consultations with your clients, so we can go line by line what you're paying for. Okay, and that's what we're here for. So then your waiting period, once it's over, you sign your loan documents, and Luis does the great job of turning in your keys. I'm always behind the scene on Zoom or on the phone. I don't get to do the fun stuff like delivering keys and being there at the big party. I just see it on social media.
Yes.
But I'm like, I'm cheering for you behind the scene. I'm cheering for you. One day, when I can get out.
Right.
I
Give
can't
us
get out, but
for a
if I
bit.
get out, they're like, Luz, where are you at? All right, I don't know what happened here. Let me scroll right through here. All right, so we are at the end of the presentation. So your next step is to book an appointment with us to learn more about where you're at when it comes to your finances. And if you're ready to purchase now, we will get you prepared to submit an offer immediately. Or if you are not ready, what do you need to do to get ready for the future, right? So we can
Mhm.
set up that roadmap for you. The pre-approval Zoom consultations take about 20 minutes after you turn in an app. We are only running a soft pull. We're going to check with you immediately, let you know what you need, if anything is missing. And my calendar is also live online, so you are more than welcome to please check my calendar. My website also has the application. This is what it looks like on a mobile or online. You can just click on the website and see what you can get. All right, let me see. All right, so I do have a question here. Um, what about a limit to ask credit from the seller when buyer's already getting a grant, or does it matter? So all the guidelines stay the same when it comes to requesting seller's closing costs. So for conventional loan, you can request up to 3%, and for an FHA loan, you can request up to 6%. So it doesn't matter what type of DPA or grant program you have, right? We just can't exceed the seller contribution on those percentage. So 3% for conventional, 6% for FHA. So I have a deal right now. My client's getting $14,000 his initial deposit back because the seller ended up giving us all the credit for the closing costs instead of repairs. So now my client got the down payment assistance, we got the closing credit, so his initial deposit goes back to him, right? And we're starting to see that often because we're getting credits back, right? So I think that will be an amazing thing. So will that lower the grant that they received, correct? Well, it doesn't lower the grant. It just, so we can use the grant towards the down payment. So if the seller, for example, helps you and contributes all the closing costs, which is, let's say, 3% for an example, and the grant gives you, 3% down payment assistance and 2% grant, we can use all that money towards the down payment, so we don't lose, right? We don't lose on the advantages that these programs are going to give us. So those are two different things, and this is why some programs say you can only use this money for closing costs, and some programs say you can use this money for closing costs or down payment, right? So in the case the seller gives us everything and we have grants and down payment available, then we're going to use all that money for down payment. So we will structure that for you. This is what we're here for, to figure out and navigate how to push forward with these loans. All right, Luis, any
All right,
questions,
awesome.
any feedback, anything else that I might have missed?
Not my
No?
part.
Okay.
So thank you again, Luz, for hosting
Yeah.
it.
Yes, of course, of course. I love doing this. This is what I do 4 to 5 times a month.
You're a pro.
And we're here to help you. So if you guys have any questions, feel free to apply with us. You're more than welcome to set up a consultation with us. Feel free to reach out to Luis. If you have any questions on the buying side, how the process works from the real estate purchase contract perspective, um, look for his invitation in the future for
Yes.
webinars. And, we look forward to helping you. And if you have any questions that we didn't answer, please feel free to email us.